Hey everyone, Mike Higley here with Proactive Accounting. We've been getting a lot of questions about what's in the new tax bill. So today we're going to go over the major tax changes that are in the new tax bill, which has been dubbed the One Big Beautiful Bill Act. Now, this bill was signed by President Trump on July 4th of 2025. Its primary goals were to make the 2017 tax cuts permanent. Now, if you're my client, we've been saying this for years that, hey, these are set to expire. Some of these changes, the lower tax rates, the higher child tax credits, things like that. And so they made a lot of those permanent. They also say they were trying to deliver middle class and senior tax relief. Whether they achieved that or not, I guess we'll find out. And then expand family and educational savings incentives. Now, this new bill is estimated to cost somewhere between $2.8 trillion and $3.4 trillion over the next 10 years. Many of the provisions are retroactive to January 1st of 25, so we'll be dealing with them when we file tax returns this coming April. Okay, so first off, what were the provisions that were made permanent? Number one, the lower tax brackets. Like I say, 12% was essentially our lowest bracket we've had in a long time, and those were made permanent. That higher standard deduction, which for 25 will be 31.5 for married filing jointly, 15,750 for single individuals. In conjunction with that standard deduction, they also changed, you may or may not remember, allowances. It used to be basically you got roughly $4,000 per individual on the return as an additional deduction. They got rid of the allowances and upped the standard deduction, so that made that change permanent. These home mortgage interest deduction limitations are permanent, meaning home mortgages over $750,000 will be prorated on the interest that you can deduct. The state and local tax cap was raised. It was $10,000, and that was a problem for a lot of people because a lot of people hit that cap easily. And so they've raised that to $40,000 for married filing jointly, $20,000 for single individuals. They kept that enhanced child tax credit and even increased it a little bit. So you'll be getting $2,200 per qualifying child instead of $2,000. They kept the higher estate and gift tax exemptions, meaning that when you pass away, your estate's valued, and that's going to roughly, I think, $15 million per individual is going to be exempt from estate taxes. The pass-through business income tax deduction, commonly called QBI, qualified business income deduction, was made permanent. That's 20% of pass-through profits, like if S corps or partnerships. And then bonus depreciation has slowly been declining over the last couple of years and was set to be eliminated in 26, I believe. That was made permanent and back up to 100%. So those are the permanent changes that came about in the Tax Cut and Job Act that were made permanent by this One Big Beautiful Bill. Let's talk about the child tax credit. Now, like I say, it does increase to $2,200 per child, and that's for children under the age of 17 at the end of the year. So the year they turn 17, they lose that enhanced child tax credit. There is a refundable portion of up to $1,700, which is a little bit higher. It phases out for those high income earners, $200,000 for single, $400,000 for married filing jointly. It will start adjusting for inflation starting in 26, where it's just been the same, $2,000. It will start changing with inflation. There are some minimum income requirements in order to get the refundable portion, right? You have to have a minimum amount of income. And so just that's important to keep an eye on your AGI so that you don't lose those enhanced child tax credits. Now, this was a big one. They are exempting from income tax, or essentially giving you a deduction for your tips and your overtime pay. For tips, that's up to 25% annually can be excluded. Overtime pay, same thing, up to $25,000 for married filing jointly. And it applies to W-2 workers making less than either $150,000 if you're single or $300,000 if you're married filing jointly. This will need to be reported by your employer, so I'm sure they will be updating the W-2, maybe even the W-4s to calculate your withholding, to report, your tip income, your overtime income. There'll be new boxes, I'm certain, on the W-2. The one thing about this is it's only temporary. It's only for 4 years, 2025 through 2028. And again, you're going to want to keep an eye on those income levels to make sure you don't lose that deduction for tip and overtime income. Now, we're not certain, again, whether they'll get the W-4 changed anytime soon, so that, in your paycheck, you'll start to see, a little bit less taken out. We're still waiting to see what's going to happen with that. This is another big one. Many of you may have received an email or a notice from Social Security essentially inferring that they had taken off the tax on Social Security. It's not technically correct because the way they passed this tax legislation, they were not allowed to change Social Security. So Social Security is still going to be calculated the exact same way. They just basically said, okay, for anyone 65 and older who makes less than $75,000 if you're filing single, or $150,000 if you're filing married jointly, we're going to give you an extra $6,000 deduction, right? So if you're both over 65, making less than that threshold, you'll each get $6,000 additional deduction, and that's in addition to your standard deduction. And that they estimate that deduction should wipe out the tax effect of Social Security on something like 80 to 90% of Social Security recipients. So that's kind of nice. Even if you're 65 and you're not quite taking Social Security, you'll still receive that deduction. Again, this is only temporary though. This is only for the 4 years, 2025 through 2028. So it includes this year. And again, most, they anticipate roughly 80 to 90% won't owe federal income tax on their Social Security. Now, I don't know if this one's going to have huge effect, but I thought it was important to mention. There were some changes to the charitable contributions. There's two different parts. One, if you itemize, or take the standard deduction, you get a new $1,000 if you're single, or $2,000 for married filing jointly, above the line deduction for your charitable contribution. Now, this is in addition to your standard deduction. So this is to encourage people who are taking the standard deduction to still have charitable giving, right? And so this is in addition to the standard deduction. Now, if you itemize, there's a floor, and that means they're going to basically subtract some of your charitable contribution deduction based on your AGI. So it's 0.5%, so half of 1%, which means, if you make $200,000, they'll reduce, and you itemize, they'll reduce your charitable contributions by $1,000 before it factors into that itemized deduction calculation. Now, as a planning tip, just remember you can do what's called deduction bunching, where you basically do all your charitable donations in 1 year and then skip a year, or you can use what's called a donor advised fund, where you get the deduction when you put the money in, not necessarily when you give the money to a charity. So you could put extra money in 1 year, take the deduction all in 1 year, still give money to your charity in both years, and get the deduction in the 1 year. So that is definitely a planning tip you'll want to talk with your tax advisor about. This one's a little more, I don't want to say controversial, but there's a removal of the green credits, meaning that they're changing. The big one is the solar credit, I think. That one's going to be done away with at the end of this year, meaning if you want to take advantage of the 30% solar tax credit, you must have I believe you have to have the system installed and operating by December 31st. So, again, some planning ahead. I'm guessing solar companies are going to be really busy till the end of the year, and then I don't know what's going to happen to them at the beginning of the year. Electric vehicle credit, that's $7,500 for buying an EV, ends, now notice the date on this one, September 30th of this year. So you have a much shorter window to take advantage of those EV credits. If you've already bought one in 2025, you're okay. Same with the solar. If you already got it and it's installed and operating, you'll still get that credit for 2025. You just won't pass those expiration dates. And then there are some additional, commercial clean energy investment incentives that are going away. Again, watch those dates. Make sure you take advantage of those credits that you're looking to take advantage of. This one's kind of interesting. They call it the Trump MAGA account, and it's basically $1,000 boost from the government for children born in 2025 through 2028. And it will likely come in the form of a tax credit, but it's a savings account that you can open for your child. You get this $1,000 tax credit, right? This $1,000 boost from the government, and then you can put up to $5,000 in it per year per child. It works kind of like the college savings plans, the My 529 plans that many states have, right? So you put the money in it, it grows, and then they can use that for tuition, daycare, tutoring, etc. Again, it grows tax-free as long as you withdraw money for qualified things. The money you put in is not deductible though, and then like I say, it is an alternative to that 529 plan. I believe, and I can look into it, but I believe if you don't use the money, then it can be converted to like an IRA or something like that. When the child is done with college or whatever. Okay, those are the major changes. Remember, this is not considered tax advice. Always consult your tax professional. But if you do have questions, feel free to reach out. I've got my email, my office phone number. My staff's always ready to answer questions, or I'm here to answer questions. And let us know comments or questions, and have a great day. Thanks.